A key challenge in private markets in recent years has been deployment and the pace. There's been some concern around how that capital has been put to work. So Nilesh, why don't we start with you? How are you thinking about deployment and just valuations overall in your market?
Coming back from sort of 2021, we think the valuations are in a very reasonable territory today. So we expect to be leaning in terms of deployment and be very active in the coming year. Having said that, I think also coming back from 2021, there is a dumbbell of two types of companies. Interesting de-risked late stage, clinical stage opportunities that garner all the interest from investors, and everything else is just struggling. And so clearly we will look at opportunities where there's a disconnect between what the company has and what the market is telling them, and we'll continue to do some of the good later stage de-risked investments. So overall, I think we'll be leaning in to be more active, considering where the valuations are. I think they are in reasonable territory for most part.
And as we think about the early stage venture environment, I think if we think about the next 12 months, we're cautiously optimistic that we'll see sort of stable to increased levels of deployment across the market. We're surely going to be active, but coming down from, as Nilesh mentioned, the 2021, 2022 era where we saw deployment at really an all-time high, we've definitely come down back to reality over the past number of quarters. And I think what that means is it's not hit absolute rock bottom. We're just back to levels, prior to 21 and 22. And so we are cautiously optimistic that we're going to still see a good amount of investors investing at seed and Series A in the early stages.
Yeah, I would add, building on what Nilesh and Jackson said, related to valuations becoming more reasonable, it also feels more actionable to us, because a lot of what we saw after the 2021, 2022 period, we sort of saw through 2023, companies couldn't get the valuation expectations they had, but they didn't want to take a down round, so they would delay the round if they could, if they didn't need the capital. We also saw a lot of insider bridging just to keep it flat and give companies time to grow into their valuation. And if we roll forward to today, we've worked through a lot of that, right? There's only so many times the company can wait to raise if they need cash. There's only so many times they can inside bridge. And so that's all largely faded away now. And I feel like the deals we're seeing are a lot more actionable. And so we do think we're in a better period for continual deployment from here.
And that flows into the late stage private market, where unquestionably those two dynamics you just mentioned, companies running out of money and companies facing a more reasonable valuation backdrop, are creating opportunities in the late stage private market. On the companies running out of money, to your point, many companies last raised large financings in 20 or 21, so they're now 3 or 4 years from their last major capital raise in the late stage private market, and therefore probably need more cash. And then when it comes to valuations and the threat of a large down round, many of the companies in the late stage private market are growth businesses. And so even though they may have been wildly overvalued in 2020 or 2021, they are multiples in size larger today. So even though the multiple at which they raise money at may have come down, the revenue base that you apply that multiple at has likely gone up. And that means that instead of facing a large down round necessarily, they can raise something flat or only slightly down.